What's up, traders? So today I'm going to show you why I want to get into both Nvidia and Tesla stock before it's too late and how I'm going to use options in order to do it. Now, if you're new to the channel, my name is Rashad. I am a full-time options trader and I bring in multiple six figures a year from the stock market. And I use the money I make from the stock market in order to pay for my entire lifestyle. Now, when it comes to Tesla, I'm a huge fan of both the product and the business. I bought myself a Tesla back in 2001 as a birthday gift to myself. Now, what's even better is that in 2021, I made enough from Tesla stock alone to pay for the entire car. And now if we fast forward to current times, I make enough just from Tesla stock in order to pay for all of my expenses multiple times. So needless to say, Tesla is one of my favorite stocks to trade. But if we look over here at Tesla, we can see it's currently $394. The market cap is about $1.2 billion and it has a trailing 12 months PE ratio of 201. So by all means necessary, Tesla stock is currently overpriced based on the type of business they are today. Now, as of early 2025, over 90% of Tesla's revenue still comes from cars. And if you're buying shares of Tesla today, just because you like it as a car company, well, you are well overpaying for what it's worth. However, I'm interested in Tesla because of its near-term future endeavors within the world of robotics. And their first step into robotics will be their self-driving cars. Now, me being a Tesla owner myself, I've seen over the years how their self-driving cars has increasingly improved over time. And as of late, they've even been releasing new updates almost every other month. And every single update has made it better and better and better. And I will say that just my personal opinion, I think it's about 8 to 12 months away from it being able to drive itself. But once they perfect that and launch the robo-taxi, the amount of new revenue and cash flow that Tesla could see from this is insane. And prior to the election, one of the biggest hurdles that Tesla had was state regulation preventing self-driving cars. However, now that Elon Musk has basically become best friends with the upcoming president, that'll definitely change things. But you don't have to take my word for it. Listen to what this analyst had to say.
Talked about another name that's obviously garners a lot of the attention within the industry, and that is Tesla. We've gotten more bullish calls out this week. Dan Ives over at Webbush being one of those, just talking about the new market cap milestone that we could see here from Tesla in the new year. I'm not sure you're totally on board with this. What are some of your biggest concerns when it comes to Tesla in 2025?
No, so we are on board. We have a buy rating on the stock. We had been at a hold. We went to a buy the day after the election, and since then, the stock is up almost 90% in just a little over a month. It's been, about 6 weeks. It's been an incredible run for the stock. I think the stock is pricing in a much easier regulatory environment for autonomous driving. And we think Tesla has the best technology out there, and they're really going to be the biggest winner from that. We've heard the President-elect Trump transition team talk about how that's one of the number one priorities of the U.S. Department of Transportation is easing the regulatory framework to make autonomous vehicles a reality. And so that's really the future of Tesla. And, if they succeed in doing that, that unleashes a enormous market opportunity for Tesla. And, in the meantime, they continue to improve the full self-driving product. Version 13 just recently launched with significant improvements over the prior version. You're really seeing their efforts incorporating AI into their development has really improved the product over the last year or two. So we continue to like the stock.
So how would I trade Tesla knowing that they're overpriced based on their current business model, but knowing that they could be the new leaders in a multi-trillion-dollar industry soon? What I'm going to do is I'm going to sell puts in order to buy Tesla at a cheaper price. Now, if you're new to options, when you sell a put, you are agreeing to buy shares of a company at a cheaper price than what it's selling for today. And because you're taking on that risk of the stock price dropping, you get paid a premium up front. And I always use the analogy of car insurance. You likely have a car, and if you have a car, you probably have car insurance. Well, the reason you pay for car insurance is because you are fearful that you may possibly get into a crash, and if you do, you want the car insurance company to pay for your expenses. Well, that is exactly how selling a put works, but instead of a car crashing, you're insuring a stock crashing. So here's how this looks. Let's say ABC stock is currently selling for $100, and you can go to a put buyer, say, hey, I will insure your stock for you. I like the stock at $85 and it's currently at $100. You can pay me $200 right here, right now. And if the stock were to drop below $85, let's say within the next 30 days, I will buy the stock from you at $85. And once you do that, here's the two things that could happen. So one, ABC stock throughout those 30 days stays above that $85 strike price that you sold the put for. And if that happens, You just keep the $200 you were paid and you go about your day. And usually when you sell puts, that is the result that you want. But the second thing that could happen is ABC stock drops below the $85 strike price that you set, and then you still get to keep the $200 you were paid. However, now you need to purchase 100 shares of the company per contract at $85. Now, let me tell you why I believe that is a win-win. Well, one, you either got paid just to wait around because the stock never crashed, or two, you got paid to buy a company that you like at a cheaper price than what it was selling for previously. And as long as you're selling puts only on stocks that you actually like, then that is the case. And to me, that's a win-win. I really can't lose. Now, here's the thing with selling puts on Tesla. So Tesla is currently $394. So since every contract is worth 100 shares, you would need to have a pretty decent sized account in order to buy 100 shares of Tesla. But let me show you how you can achieve similar results even with a smaller account. So I like to personally utilize leveraged ETFs. Now, if you've never heard of a leveraged ETF, they are simply an ETF that looks to follow a stock or a sector and move 2 to 3 times the stock or sector that they follow every single day. So an example would be if a leveraged ETF follows Apple and Apple moves up 1%, a leveraged ETF will look to move up 2 or 3% for the day. And the same works in reverse. If Apple were to move down 1%, the leveraged ETF following Apple will look to move down 2 or 3% for the day. Now, there are 2 reasons that I find it beneficial. One, because the more that a stock moves, the higher the premiums tend to be. So when we sell that put, we would get more money from selling a put on a leveraged ETF that follows Apple instead of just selling a put on Apple itself. And the second reason is leveraged ETFs tend to be a smaller stock price than the stock or the sector that they follow. And that is the case for ticker symbol TSLL, a leveraged ETF to Tesla. All right, so here I have TSLL pulled up and you can see it is currently $25, which is a lot less than the almost $400 that Tesla stock price currently is. And it is a 2x leveraged ETF to Tesla. So it looks to move 2 times the daily move of Tesla. But we can see assets under management currently 4.7 billion, and the implied volatility is 126%, which is very, very high, which means the premiums are very, very good. Now, there are a few data points that I look at prior to selecting the strike price I would like to use when selling puts. And the first one is the Bollinger Bands. So here I have the Bollinger Bands pulled up, and you can see they are the black lines here, but they simply aim to show you the range that a stock price is expected to trade within. So you can see at the bottom is 24.49 and the top band is 35.14. So the Bollinger Band currently expects TSLL to stay within that price range from 24 to 35. And typically it's about 95% accurate. You can see here every time that it will pop out of the Bollinger Band, it popped back in. Popped out, popped back in, and normally it is within the Bollinger Band. But now that we know that TSLL is currently expected to stay within that range, let's head to Thinkorswim and look at the second data point. All right, so now I have TSLL's options chain pulled up, and the next thing I need to do is select the expiration date. Now, typically I go anywhere up to 45 days. However, I would like to be assigned these shares sooner than later, so I'm going to select an expiration date that's a little bit closer. So let's say we'll go over to this expiration date that is 26 days out from now. So I'll go ahead and open it up. And now the second data point that I need to look at is the delta. We can see we have the delta column right here. And by definition, delta is the amount that the premiums will move based on a $1 move in the underlying stock's price. However, most traders use delta to find out the probability of an event occurring. And so say if we were to come down here to this $20 strike, it has a delta of 0.19, which means there's about a 19% chance that TSLL's stock price drops down to that strike price of $20 by the expiration date that is 26 days out from now. Or in other words, you would have about an 81% chance of probability of profit. And now typically, because I have a very large account, I would select a delta of 0.20 or lower. However, with TSLL, I want to be assigned the shares sooner than later. I want to buy the stock and I want to do it soon. So I'm going to use a delta of 0.30. So if we scroll down here, we can see that the strike of $23 will get me closest to 30. And we can see that the last contract that went through went through for $2.27. Now, if you're new to options, every contract is worth 100 shares. So that 227, if we were to sell a put, is how much you would receive per share. So you would receive that times 100 because every contract is worth 100 shares. So we will receive $227 right here, right now for selling the put, or AKA for insuring the stock. All right, and so TSLL is currently trading at $25.92, and I'm selling a put at $23 and receiving $227 for doing so. Now, as long as TSLL stays above that strike price throughout the expiration date, I just keep the $227 that I received and I go about my day. And I can continue to do the trade over and over and over again if I like. However, I would like the second option. I want to be assigned the shares. I sort of want TSLL stock price to drop below my $23 strike, because I'll then get to keep the $227 I was paid, and then I also get to buy the shares of the company. So I'll come over here, I will right click and hit sell, and then go to single because it's a single leg trade. And this is just for example purposes, but let's say I want to do about 5 contracts. So I'll go ahead and select 5, and I already have my premium set. So I'll come over here, hit confirm. Now you can see here for this exact trade, I would receive $1,135 immediately for selling these 5 contracts. And that is mine to keep regardless of what happens with TSLL stock price. And if we look at this column right under it, you can see the max loss says 10,365. Now, don't let that number scare you. That is showing that what would happen if TSLL's stock price went to $0 within the time you were in the trade. And hopefully we can all agree that Tesla is not going to go out of business here within the next 26 days. It is one of the largest companies, and it is the most valuable car company in the entire world. And they have amazing and growing cash flow, and they have a bright future ahead of them. But that is how I'm currently trading TSLL in order to get access to Tesla. All right, so now we're currently looking at Nvidia. It's a $135 stock price. It is a $3.3 trillion company, and they have a trailing 12 months PE ratio of 56. So nowhere near as expensive as Tesla, but still far from one of the cheapest companies. But if we look at Nvidia's fundamentals, they are amazing. I mean, just look at this growth in their revenue over the last 5 years. In the year ending 2020, they did $10 billion, 2021, $16 billion, 2022, $26 billion, year ending 23, $26 billion, and then the year ending 2024, $60 billion. And very soon we'll get the information for the year ending January 2025. But it's pretty fair to say they will have grown revenue again. And their margins are amazing. But the reason I'm highly interested in Nvidia is very similar to the reason that I'm highly interested in Tesla. It's robotics. We all know that Nvidia is currently the king when it comes to AI chips. However, with robotics and self-driving cars making a huge leap forward, Nvidia's chips are going to be needed now more than ever before. And here's what the CEO of Nvidia said at his recent presentation at CES.
Revolution has arrived. After so many years, with Waymo's success and Tesla's success, it is very, very clear autonomous vehicles has finally arrived. Well, our offering to this industry is the 3 computers: the training systems to train the AIs, the simulation systems, and the synthetic data generation systems, Omniverse and now Cosmos, and also the computer that's inside the car. Each car company might work with us in a different way, use 1 or 2 or 3 of the computers. We're working with just about every major car company around the world. Waymo and Zoox and Tesla, of course, in their data center, BYD, the largest EV company in the world, JLR's got a really cool car coming. Mercedes has a fleet of cars coming with Nvidia starting this year, going to production. And I'm super, super pleased to announce that today, Toyota and Nvidia are going to partner together to create their next generation AVs. Just so many cool companies, Lucid and Rivian and Xiaomi, and of course, Volvo, just so many different companies. Wabi is building self-driving trucks. Aurora, we announced this week also that Aurora is going to use NVIDIA to build self-driving trucks. Autonomous, 100 million cars built each year, a billion vehicles on the road all over the world, 1 trillion miles that are driven around the world each year. That's all going to be either highly autonomous or, fully autonomous coming up. And so this is going to be a very large industry. I predict that this will likely be the first multi-trillion-dollar robotics industry. This business for us, notice in just a few of these cars that are starting to ramp into the world, our business is already $4 billion, and this year probably on a run rate of about $5 billion. So really significant business already. This is going to be very large. Well, today we're announcing that our next generation processor for the car, our next generation computer for the car is called Thor. I have one right here. Hang on a second. This is Thor. This is a robotics computer. This is a robotics computer. It takes sensors and just a madness amount of sensor information, process it, umpteen cameras, high resolution, radars, lidars, they're all coming into this chip. And this chip has to process all that sensor, turn them into tokens, put them into a transformer, and predict the next path. And this AV computer is now in full production. Thor is 20 times the processing capability of our last generation Orin, which is really the standard of autonomous vehicles today.
So with that being said, you can see why I'm so bullish on Nvidia. Now, what I want to do with Nvidia is the same thing I did with Tesla, is I want to sell puts in order to buy the shares at a cheaper price. But instead of selling puts on Nvidia, ticker symbol NVDA, I'm going to sell puts on the leveraged ETF that follows Nvidia, which one of them are NVDX. So we can see that NVDX is currently trading at $14. So this is an easy stock to trade if you have a smaller account because you don't need that much money in order to trade it. And we can see that implied volatility is 87%, which is not as high as tsla, of course, but it is still very good. So we still should be able to get some good premiums. So let's go ahead and look at our data points again. So here we have the chart for NVDX, and we can see that the Bollinger Bands currently say that it should stay within a range of $13.93 and $16.86. And it is obviously right here at the bottom of the Bollinger Band, which is the best time to sell puts, because this means that we could possibly see some good support right here. So let's head over to Thinkorswim. So now I currently have NVDX pulled up in the options chain. And what I want to do is I want to stick with the exact same expiration date that we used for tsla. So that was 26 days out. So I'll go ahead and open that up and I'll come over to the delta, and we were wanting to stay around a delta of 0.30. So it looks like the strike of $13 will fit that bill very well. It is a delta of 0.32. And we can see that the last contract that went through for 90 cents. So we would immediately receive $90 upon opening this trade if we were to get that exact same premium. So again, I will right click, go to sell, go to single. And again, I will just go over here and I'll do 5 contracts just for the example for this video. And I'll come over here and hit confirm. And if we come up here to max profit, I'll receive $450 right here, right now for opening up this exact trade. And then my max loss, if NVDX were to go to 0, which is very, 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 very unlikely, my max loss would be $6,050. And again, we can see that NVDX stock price currently is $14.15. So as long as NVDX stock price stays above the $13 strike that we set, we keep the money that we received and go about our day. However, if the stock price drops below the $13, then we buy the shares of the company, but we still get to keep the money we receive. And again, remember, I am doing this because I do want to buy shares of the company. However, if that never happens, let me show you how amazing of a return this is. All right, so if we take the premium we received, which was $450, and then we divide that by our max loss, which was $6,050, that gets us to a return of 7.4%. And that's just a return over the 26 days that we could be in the trade. Now, if we go ahead and annualize it, so 26 days is roughly a month, and we know that there's 12 months in every year. So just to do some simple math, I'll go ahead and multiply this by 12 to annualize this return, and then multiply it 100 in order to get our percentage. And that will be 89.2% return annualized for this very trade. Now, if you just invest in the stock market, then you get about a 10% return annualized, which is great. But we just did 9 times that with this one single trade. And that there is the power of using options in order to buy your freedom back. Ladies and gentlemen, if you would like to learn more from me, feel free to join the Trade to Freedom community. Not only will you get my exact trades when I enter them, but you'll also get my entire options framework via the Trade to Freedom course, where I teach you all the basics of options trading, and more specifically, how I trade to bring in multiple 6 figures per year. And lastly, you'll be in a thriving community of other traders that all have the exact same goals as you. You can find the link in the description below. I hope to see you there. But until the next video, peace.